FATCA and CRS. How to deal with undocumented accounts. FATCA and undocumented accounts. To comply with the Foreign Account Tax Compliance Act, all accounts must have a FATCA status that their host country tax authority, HECTA, recognises. FATCA offers two different models for intergovernmental agreements that form the basis for reporting relationships between the United States and other jurisdictions. Generally, the host country tax authorities in tax jurisdictions that use Model 1 intergovernmental agreements have their own FATCA reporting schemas. The exception is Singapore, a FATCA IGA Model 1 tax jurisdiction that uses the US International Data Exchange System IDES for FATCA and its own local schema for Common Reporting Standard CRS purposes. When reporting for FATCA, every financial institution must assign all of its customer financial accounts a FATCA status that is acceptable to the FATCA schema that the financial institution's host country tax authority uses for that particular year. Undocumented accounts were allowed in 2014 on both high value and low value accounts. Undocumented accounts were allowed in 2015 for low value accounts. This is because financial institutions had 1 year to classify high value accounts and 2 years to classify low value accounts. For the purposes of FATCA reporting, as opposed to CRS reporting, the undocumented account status does not exist after 30th of June 2016, with the exception of new accounts that have been open for less than 90 days. This is because all customer financial accounts must use an acceptable schema status within 2 years after the trigger date for FATCA compliance. Typically, that trigger was July 1, 2014. Whatever nomenclatures a financial institution may use internally as proxies for non-classification, unclassified, unknown, not determined, or something else, host country tax authorities assume that these no longer exist. This is because the rules required financial institutions to complete classification within the 2 years allotted from the start of their FATCA obligations. Thus, host country tax authorities assume that financial institutions reclassified all de facto undocumented accounts before FATCA reporting for the fiscal year 2016 in 2017. There are, however, at least 4 problems with this assumption. 1. It is not true. Many financial institutions have pre-existing customer financial accounts that they have not classified with a FATCA status that their own host country tax authority reporting schema recognises. 2. The FATCA withholding and FATCA reporting obligations are always contextualised by the FATCA status that the host country tax authority's reporting schema recognises. If a customer financial account does not have a FATCA status that its own host country tax authority reporting schema recognises, then the financial institution has failed to determine its FATCA reporting and FATCA withholding obligations. There is a term for this, non-compliance. It is widespread and leads to the third problem. 3. Many financial institutions assume that there is no FATCA withholding under an intergovernmental agreement. What many do not appreciate is that the ostensible lack of reporting under an IGA is, and always has been, conditional. The conditions are that A. All customer financial accounts have a FATCA status, as detailed in Annex 1 of the IGA, that is recognised by their own host country tax authority reporting schema, and B. The institution reports any recalcitrant account holder, a FATCA status recognised by the reporting schema that all host country tax authorities use as required. Only if 3A and 3B are true is there no FATCA withholding under an IGA. If 3A is not true, then the institution has not properly classified many recalcitrant account holders. If the institution has not classified recalcitrant account holders correctly, then it has not reported them as recalcitrant account holders. FATCA withholding applies to unreported recalcitrant account holders, notwithstanding the IGA. Under an IGA, it is the act of reporting recalcitrant account holders that negates applying FATCA withholding to them. If the financial institution has not given financial accounts a FATCA status that their own host country tax authority reporting schema recognises, then the financial institution will be unable to give the IRS the certification of pre-existing accounts, COPA, that is due by December 15th, 2018. And I should explain, the COPA is only due for FIs in Model 2 jurisdictions, that's IJ Model 2 jurisdictions, and non-IGA jurisdictions. However, if a financial institution in an IJ Model 1 tax jurisdiction fails to give each account holder of a customer financial account a FATCA status that is recognised by the reporting schema used by their own host country tax authority, then it is not compliant with the Inter Governmental Agreement Model 1, in particular Annex 1. Qualified intermediaries and undocumented accounts. Further, a financial institution in a Intergovernmental Agreement Model 1 tax jurisdiction that is also a qualified intermediary will be unable to truthfully make the certification, the QI certification, required by the QI regime concerning FATCA compliance because it has not complied with the FATCA IGA, in particular Annex 1 of the IGA. The introductory section of the QI agreement states that a financial institution in a Intergovernmental Agreement Model 1 tax jurisdiction must document its account holders in line with Annex 1 of the IGA. From the IRS's point of view, a QI in an IJ Model 1 tax jurisdiction is deemed compliant, but deemed compliance cannot be assumed if financial accounts have not been given a FATCA status recognised by the reporting schema used by their own host country tax authority. COPA, undocumented accounts, and timing. Some leading experts believe an unqualified COPA is possible even if the institution did not give FATCA statuses to all pre-existing financial accounts by June 30th, 2016. Certainly, if all pre-existing financial accounts had a FATCA status by December 31st, 2016, then an unqualified COPA certification is possible. Some experts may go so far as to say that if all pre-existing customer financial accounts had a FATCA status 1 year later, by December 31st, 2017, then an unqualified COPA is still possible. However, if at the time the COPA is due, which is December 2018, there are pre-existing financial accounts that do not have a FATCA status that their own host country tax authority FATCA schema recognises, then the institution cannot truthfully make an unqualified COPA. To put it plainly, undocumented account is not an acceptable FATCA status unless the customer is new, meaning the customer has been with the financial institution for fewer than 90 days. What status should financial institutions who are not QIs and are in neither Model 1 nor Model 2 tax jurisdictions give to previously de facto undocumented pre-existing accounts? Step 1. Assume US citizenship if there is any US indicia, unless there are non-US indicia and no US indicium. If there are both US indicia and non-US indicia, the US indicia prevails and the entity is a US person for FATCA purposes. So if at the end of step 1 you've given the entity a reportable FATCA status, you wouldn't proceed to step 2 for that particular customer. Step 2. If the entity is a financial institution, then non-participating foreign financial institution, NPFFI, is the default status. And the reason for this is that it's the non-IGA FATCA rules that apply, i.e. the US Treasury rules that apply, not IGA rules, as there is no IGA under this scenario. If at the end of step 2, the customer financial account is not classified as an NPFFI, then move to step 3. Step 3. Classify as a passive, non-financial foreign entity with US controlling persons. So, if neither step 1 nor step 2 resulted in giving that customer financial account a FATCA status, then classify that customer as a passive, non-financial entity with US controlling persons, which is of course a FATCA reportable status. What status should financial institutions who are not QIs and in either Model 1 or Model 2 tax jurisdictions give to previously de facto undocumented accounts that are pre-existing accounts? So this is a scenario where the financial institution that's doing the CDD is under a Model 1 or Model 2 IGA. Generally, and I do mean generally because there are exceptions, there are jurisdictions that do issue specific advice, and where those jurisdictions do issue specific advice, then that is the advice you should follow for that particular tax jurisdiction. Generally, IJ tax jurisdictions provide no guidance concerning undocumented accounts to financial institutions that are located in FATCA IGA Model 1 and Model 2 tax jurisdictions. Many financial institutions in this situation apply the following approach where that tax jurisdiction has not issued specific advice. Step 1. If there are any US indicia, then treat the entity as a US person, which means give them a FATCA reportable status and report them. If at the end of Step 1 no FATCA status is attributable to that customer, advance to Step 2. Step 2. If there is non-US indicia, treat the entity as a non-US person, i.e. give them a non-reportable FATCA status. Step 3. Classify as a passive non-financial entity with US controlling persons, which is a FATCA status that is reportable. Why NPFFI, non-participating foreign financial institution status, despite what others may tell you, is not the default status for undocumented accounts in IGA tax jurisdictions. Unless there is specific guidance from the local tax jurisdiction directing them to do so, or the financial institution classifying the pre-existing customer financial account holder is a QI, financial institutions will not default undocumented entity accounts to NPFFI status. This is because IGA notwithstanding, FATCA withholding always applies to NPFFIs, unless the jurisdiction specifically states otherwise. IGA tax jurisdictions also follow specific rules for NPFFI status. It requires significant non-compliance that the entity has not resolved for 12 to 18 months. The precise time period varies by jurisdiction. By way of example, in the UK it's 18 months, in Japan it's 12 months. Instead, barring the noted exceptions, the default status is passive, non-financial foreign entity with US controlling persons, a FATCA status that is reportable. Further, in IGA tax jurisdictions, IGA Annex 1 provides that a self-certification is not required if the financial institution classifying the pre-existing customer financial account holder has information in its possession, or if information is publicly available that demonstrates that the account holder is a financial institution in an IGA tax jurisdiction. What status should financial institutions who are QIs and, in either Model 1 or Model 2 tax jurisdictions, give to previously de facto undocumented accounts that are pre-existing accounts? For financial institutions that are QIs in FATCA Model 1 or FATCA IJ Model 2 tax jurisdictions, the 2017 QI agreement applies the following presumption rules. Step 1. Assume US citizenship if there is any US indicia, unless there is non-US indicia and no US indicium. If there are both US indicia and non-US indicia, the US indicia prevails and the entity is a US person for FATCA purposes. Step 2. If the entity is a financial institution, then non-participating foreign financial institution is a default status. Step 3. Classify as passive non-financial entity with US controlling persons. I shall now explain the logic behind that position. Why QIs in Inter Governmental Agreement Tax jurisdictions must apply the US Treasury FATCA presumption rules, use NPFFI as the default status for undocumented accounts, even when this conflicts with an IGA, when the financial institution is under an IGA but is also a qualified intermediary. As noted above, FATCA withholding applies to NPFFIs even in IGA tax jurisdictions. Hence, there are also 1042S reporting duties. The US Tax Code applies Chapter 4 withholding first. There can only be Chapter 3 withholding if there has been no Chapter 4 withholding. Hence, QIs must apply the FATCA presumption rules or risk compromising Chapter 3 compliance. However, as the IRS states in RevProc 2017-15, 2017-3, IRB 437, a comment to the 2014 QI agreement raised the question of whether the presumption rules under an applicable IGA apply rather than the presumption rules in a QI agreement or in the regulations. A QI that is also a reporting Model 1 or 2 FFI may apply the due diligence procedures described in Annex 1 to document the status of its account holders under the IGA as US accounts, non-participating FFIs, in the case of reporting Model 2 FFIs, non-consenting US accounts, or in the case of Model 1 FFIs, US reportable accounts. And if such procedures are applied, cases in which an entity account holder is undocumented should not arise. And this really makes a killer point. If you're following Annex 1 of an IGA correctly, you wouldn't have undocumented accounts. As the IRS says, if such procedures, per Annex 1 of the IGA, are applied, cases in which an entity account holder is undocumented should not arise. If for FATCA you still believe that undocumented account is an acceptable FATCA status, then you probably believe in Father Christmas. How undocumented accounts are extraordinary under the CRS. In CRS, early adopter tax jurisdictions, all customer financial accounts should have had a FATCA status that is recognised by the reporting schema as described by the host country tax authority by December 31st, 2017. The deadline is 1 year later for fast followers. Host country tax authorities assume that this deadline has been met and therefore assign a precise meaning to the term undocumented account in the context of CRS. To quote one host country tax authority, let's go to the Australian Tax Office. Here I'm quoting directly and I'll tell you when I end quote. Quote, "The term undocumented account has a specific meaning in the CRS. An undocumented account may arise where a reporting financial institution finds a hold mail or in care of indicium of foreign residency for a pre-existing individual account and no address on file, and the status of the account is not determined from other documentation. In the case of a lower value account, if an electronic record search for the account has found a hold mail or in care of address in a foreign jurisdiction as the only recorded address for the account and no other reportable indicium for the account holder, the reporting financial institution must take at least one of these actions. Conduct a paper record search of certain documents specified in the CRS, or seek a self-certification or documentary evidence from the account holder to establish their tax residency. If the chosen course of action fails to resolve the status of the account, the reporting financial institution is required to attempt the other course of action. The account has undocumented status unless and until one of these actions resolves the foreign address indicium. In the case of a high value account, if the enhanced review procedures required by the CRS are carried out on the account and the only indicium for foreign residency found is a hold mail or in care of address in a foreign jurisdiction with no other address on file, the reporting financial institution must seek a self-certification or evidence from the account holder to establish their tax residency. If the self-certification is not received by the time of reporting, the account remains an undocumented account. The hold mail, or in care of circumstances described above for pre-existing individual accounts, are the only situations where a reportable account should be reported as undocumented. An undocumented account must continue to be reported for subsequent years until its status is resolved. A reporting financial institution must, in the case of a high value account, repeat its request for documentation annually until resolved. Examples of making such a request could be by letter, email, or a request during face-to-face contact. A request is not required for low-value accounts on an annual basis. However, reporting financial institutions are encouraged to renew their request from time to time." End quote. A new-to-bank customer financial account that is less than 90 days old can also be an undocumented account. At first glance, this narrow definition of an undocumented account under the CRS may seem to contravene CRS Section 3(b)(5). However, there is no contravention. Instead, this is merely a de facto assumption that the 2-year deadline for classification has already been met and that only very narrow conditions remain in which the undocumented account can exist under the CRS regime. To summarise, undocumented accounts are no longer allowed for either FATCA or for CRS. And also for extra emphasis, I'm going to quote the UK's HMRC. In the United Kingdom, Her Majesty's Revenue and Customs has advised that financial institutions are wrongly reporting accounts as undocumented where an account holder has not completed a self-certification that the institution requested. These are, of course, recalcitrant account holders. This has led to numerous accounts being erroneously reported with a Great Britain GB resident country code. The United Kingdom's Exchange of Information Manual, which includes DAC2, CRS, FATCA and UKC, explains, quote, an undocumented account can only exist for CRS reporting purposes. An undocumented account exists where the conditions CIEIM 403040 exist. That is, the only indicators that the financial institution hold are a hold mail or in care of address, and the financial institution has been unable to obtain a self-certification from the account holder to cure the information held. So HMRC have told us that for FATCA there's no such thing as an undocumented account status, but for CRS there is, under very exceptional conditions. I hope that's clear now, even if you do believe in Father Christmas. No such thing as undocumented accounts for FATCA. There are such things as undocumented accounts under the CRS, but they're truly extraordinary. Whilst this is true, financial institutions have many undocumented accounts under both regimes, whether that be allowed or not. So what is being done to fill this gap? France is one of the tax jurisdictions that has taken the lead. On July 4th, 2018, France issued Decree number 2018-859. And if you go to the KPMG website, you'll find a discussion of the decree. This decree requires financial institutions to provide a supplementary FATCA or CRS declaration by July 31st each year, identifying account holders who do not provide all the information necessary to identify their tax residencies and tax identification numbers, i.e. recalcitrant account holders. Next steps. For both FATCA and CRS, financial institutions should map their customers' FATCA and CRS statuses to the host country tax authority schemas. If there are any customer financial account statuses that do not map to the schema, then those are invalid for the purposes of FATCA and the CRS. Financial institutions should identify these cases and use pre-existing AML or KYC information or publicly available data to map these customers to a FATCA or CRS status that is recognised by their host country tax authority. If this cannot be done, the institution should try to obtain a self-certification from the customer. 2. Financial institutions should identify any customers with undocumented accounts that are new to bank, that is, the customers are older than 90 days, if neither the hold mail nor in care of circumstances described above apply. They should use pre-existing AML or KYC information or publicly available data to give these accounts a FATCA status or CRS status that the host country tax authority reporting schema recognises. If this could not be done, the institution should reach out for a self-certification. Notably, the response rates for self-certification solicitations are, at the very best, 10%. Typically, 65% of first responses will be invalid. The financial institution must validate self-certifications, preferably via an automated product solution, such as that provided by Tina, for whom I wrote the tax self-certification rules. 3. Having solicited for the customer for a tax self-certification, if the customer has not responded within 60 days, to re-solicit for a self-certification. I personally would always advocate for a tax self-certification, but there are complications. A link coming up on your screen now explains the nuances and complications of CDD and asking for tax self-certifications. Moving on. Reaching out to the customer for a tax self-certification. Naturally, when disclosing which customers have not submitted the information needed to identify their tax residencies and their tax identification numbers, recalcitrant account holders, the financial institution must be able to provide evidence that it solicited this information. The term recalcitrant is predicated on the financial institution reaching out to the customer with reasonable requests for a self-certification and those requests going unanswered 90 days after being requested. Host country tax authorities assume that, for undocumented pre-existing accounts, institutions made these requests for FATCA by 2016, for CRS in early adopter tax jurisdictions by the fourth quarter of 2017, or for CRS in fast following tax jurisdictions by the fourth quarter of 2018. There are several reasons why host country tax authorities make this assumption. These include, but are not limited to, it is the only way that the institutions could have met their obligation to classified customers within the 2-year regulatory deadline. This is true for FATCA, US Treasury versions of FATCA, Model 1, Model 2, non-IGA. This is true for CRS, early adopters, fast followers, and Wave 3. Meeting the FATCA classification deadline is the only way the financial institution under an IGA could have mitigated the withholding risk that would apply if they did not identify and consequently report recalcitrant account holders. It is also the only way a financial institution in an IGA Model 2 or non-IGA tax jurisdiction would be able to make an unqualified COPA, Certification of Pre-existing Accounts, certification by the December 15th, 2018 deadline. And it is the only way that QIs in FATCA IGA tax jurisdictions could make the QI certification stating that they had complied with the relevant FATCA IGA, particularly Annex 1. Pre-existing accounts that were unclassified 21 months after the trigger date for compliance with FATCA or CRS should have received a solicitation for a tax self-certification. This is because this would be the latest point that a customer could be given the full 90 days to trigger recalcitrant account holder status post-solicitation. If the customer did not provide that self-certification, the institution should have classified the customer as a recalcitrant account holder. In that case, there would not be any undocumented pre-existing accounts other than those meeting the extremely narrow definitions described earlier. The ugly truth about undocumented accounts. The regulations are clear that undocumented accounts are no longer allowed for either FATCA or the CRS. More accurately, they are allowed for the Common Reporting Standard, but only under very narrow and precise conditions. However, many FIs have undocumented accounts that are pre-existing accounts. FIs that have made an unqualified FATCA certification of pre-existing accounts unqualified certification to the IRS have misled the IRS if they have undocumented pre-existing accounts. QIs that have made a QI certification to the IRS or are about to make such a certification to the IRS mislead the IRS if they have undocumented pre-existing accounts for FATCA, irrespective of any FATCA IGA.